Good afternoon and welcome to this Kuan Yew School public lecture on the future of financial regulation. And we're very fortunate to have Dr. Rakesh Mohan here, who is going to be sharing with us his reflections on financial will be familiar with Dr. Mohan and his work. So let me just give a very brief introduction. Dr. Mohan has worked in both the academic and the official sectors. He currently holds appointments at the, as a professor at the Yale School of Management and as a fellow at the Jackson Institute of Global Affairs at Yale University. And immediately prior to that, he was a consulting professor at the Stanford Center for International Development. If we go back a little bit further, Dr. Mohan was deputy governor at the Reserve Bank of India, where he had responsibility in the monetary policy area. He's held numerous positions within India, including a stint as Director General of the National Council of Applied Economic Research. He's the author of numerous articles and books. Going back even further, Dr. Mohan received his master's and doctorate in economics from Princeton University and a Bachelor of Arts in Economics from Yale University. As I mentioned, he'll be sharing with us today his reflections about the future of financial regulation. Let me make two housekeeping points. First of all, if there's anyone from the media here, Dr. Mohan has indicated that the presentation will be embargoed till 5 p.m. tomorrow, Mumbai time. Singapore, I guess, is 2.5 hours ahead of Mumbai. And secondly, Dr. Mohan has indicated he'll talk for around 50 minutes, following which we'll open the floor to questions and answers. The event is being videotaped, so when you ask your questions, could you not only keep your questions short and precise, but also if you could give your name and affiliation. Well, look, Dr. Mohan, thank you very much.
Thank you very much, Charles, for that introduction. This is my second visit here to the Kuan Yew School, so I'm very pleased to be back. I was here last November, and I hope that what I'm saying is not a mere repetition. So if any of you were here at that time, tell me if I repeat things. What I'm going to do is to say a little bit about the financial crisis, what caused it, key issues, and then basically raise some of the issues that are arising given the kind of discussion that's going on what changes we made in the financial regulatory sphere. Now, as we all know, the world experienced the most severe financial economic crisis in 2008-9, probably the most severe since the Great Depression. And the interesting thing in a sense about it was that it originated in a narrow area of the financial sector, that is subprime mortgage sector in the United States, but then spread to Europe and the rest of the world with really quite amazing speed. And it became a widespread banking crisis in the United States and Europe. There was really a breakdown for a brief period of time in late 2008 on both domestic and international financial markets, and then in some sense a global economic crisis. But one interesting feature which I won't say much more on that, although I've said so elsewhere, but just to note is that we have been used in the past 20-30 years to recurring financial crises, economic crises in the emerging market economies. This time, the financial sectors in the emerging market economies, except for Eastern Europe, certainly almost all of Asia and all of Latin America, exhibited relative stability as the financial sectors. I have not come across any financial institution either in Asia or in Latin America which has really got into severe difficulty, whereas almost all the institutions in the US and in Europe did. They were, of course, more affected in the real economy because of the turndown in trade, etc. But there has been, so I've often dubbed this, that is wrong to call it a global financial crisis, just as the Asian crisis 96, 97, 98 was an Asian financial crisis, not a global crisis. This is a North Atlantic financial crisis, not a global financial crisis, although the global economy did get affected significantly. Now, given the kind of crisis that we've gone through, this could really be an epoch-changing one for central banks and financial regulatory system. The crisis occurred after a very extended period, which many people have called the Great Moderation, which was a period characterized by high global growth, huge financial sector expansion, accompanied by low product price inflation. But during this whole period, 10, 15 years before the crisis, there was higher than usual growth in monetary aggregates. One has to be somewhat circumspect in saying that because there isn't full agreement anymore on what constitute monetary aggregates. But nonetheless, to whatever extent you can look at global monetary aggregates, particularly United States and Europe, you do find that they did increase more than you might expect. And of course, there was a very significant increase in asset prices and increased volatility in exchange rates. So there was a great moderation in terms of global growth, in terms of inflation, and very large expansion in financial sector, but it was accompanied by growth in monetary aggregates, asset prices, and greater exchange rate volatility. The prevailing monetary policy orthodoxy, of course, had become inflation targeting or variants thereof, and light touch financial regulation. And in some sense, my view, if I can say it right away, is that the price of the world is paid for the practice of such narrowly focused, what I call narrowly focused monetary policy, along with inadequate macroeconomic policy coordination overall, and neglect of financial regulation and supervision has been huge. If one first focuses on the severity of the crisis, in a sense, one of the things that has happened in the crisis is huge increase in uncertainty. So from an average annual growth rate of the global economy of a little over 4% from 2001 to 2008, global growth suddenly fell to minus 0.6 in 2009. But again, the globally coordinated monetary and fiscal efforts, expansion essentially, was probably unprecedented in its magnitude and its level of global coordination through the G20. So that which went into action immediately after the Lehman episode, I think we must note that it has succeeded in averting the threat of a real economic depression. And I think that the global macro managers, so to speak, along with the national macro managers, something has happened in this period that is really very noteworthy. And the success in some sense is indicated by the fact that both things actually, that as late as July 2008, the reversal was as late as July 2008, the IMF was expecting world GDP to grow by 3.9% in 2009. That is, the July 2008 forecast 2009 was 3.9%. Actually, what happened finally was minus 0.9. Similarly, the growth forecast for 2010 was 1.9% in April 2009. Latest forecast now is of 4.5%. So the global monetary and fiscal action was in some sense more effective than actually expected a year ago. And we must recognize, I think, that success. Nonetheless, what has happened, of course, is that these huge swings, the uncertainty in the global economy continues, and more recently we saw a manifestation of that in what happened in Europe a couple of months back. So there is really still greater uncertainty in the world economy and volatility in exchange rates. In terms of the magnitude of the crisis, the global write-downs were estimated by the IMF in October 2009 at around $2.8 trillion, global write-downs in the financial sector, $2.8 trillion. That is about more than double the Indian economy, for me to get an idea what that means. And I guess about half the Chinese economy, little more than half, about half. So it's really a huge magnitude in terms of the losses that the global economy has suffered. And despite the ongoing recovery, the overall cost of the crisis has still been massive. First, households, of course, have suffered a severe reduction in overall wealth due to marked decline in property prices. That's being reflected in their consumption behavior in the advanced economies. Second, the fiscal expansion, because of which this recovery has taken place, has been the order of about 6% of GDP in both 2009 and 2010 for the G20 countries overall, mostly, of course, in a good part of the advanced economies, but in other countries as well. U.S. fiscal expansion is almost 10% of GDP. The total support given to the financial sector in 2008-9 in advanced economies was actually the order of about $7 trillion, i.e. more than the Chinese economy as a whole. These are really staggering numbers, and I'm repeating these because given some degree of normality that has come back, people tend to forget what has really happened. Of course, some of these expenditures will be recovered because they were like capital injections, etc. So I'm not saying these are all deadweight losses, but this is the kind of volume of action that had to be taken place to avert this crisis. Fourth, despite this massive effort, unemployment levels in advanced economies continue to be at about 10% or higher across the developed world, and are expected to remain at such high levels for an extended period of time. As assessed by the IMF, the output levels in advanced economies will never go back to the pre-crisis trend. So you're talking about a permanent loss that has taken place because of the crisis. And fifth and final, these are just some few metrics on the loss incurred by the economy, world economy, is that the average debt to GDP ratio for the advanced countries is estimated by the IMF to reach 120% of GDP by 2015. Again, that is something unprecedented in peacetime. It always happens that during wartime, debt of any economy increases, or the sovereign debt increases, but there's probably never been this kind of increase in sovereign debt, particularly advanced economies, in peacetime. So 120% of GDP by 2015. And so this expected increase in debt, part of it, all of it can't be attributed to the crisis, because part of it is happening in the developed economies because of the associated health and pension costs, because of the aging taking place. So I'm not saying the whole thing is because of that, but nonetheless, this is the kind of magnitude. And of course, as I said earlier, we're continuing to witness extended volatility in the exchange rates of major countries, fragility in leading capital markets, and leading to overall extended economic uncertainty, and from our point of view in EMEs, emerging market economies, possibly continuing volatility in capital flows with implications for financial stability. So the point of all of this, really, as a prelude to what I'm going to say, is the cost of the crisis has been massive. Let us not forget it, and its fiscal effects will be with us for some time to come, and therefore it's very important that we identify the causes of the current crisis accurately, and so that we can act on the longer term implications for both monetary policy and financial regulation for the future. And what is happening, of course, is that consequent to this crisis, there is a comprehensive re-examination taking place in financial regulatory and supervisory frameworks across the world. both international activities as well as individual activities in different countries. So what I'll do first is to provide a brief interpretation of how the crisis arose, in my view, in terms of shortcomings in the extant practice of monetary policy and then in financial regulation, and then attempt to analyze some of the emerging contours of financial regulation as they seem to be coming about. Now, the first point I want to talk about, which is not discussed as much as the financial regulatory system changes, is really the issue of the practice of monetary policy. And here there isn't really much of a consensus. So in some sense what I'm giving here is more of a personal view. On the financial regulation side, in some sense I'm reporting what's happening in the rest of the world, in the world as a whole. It is generally agreed, of course, that what led, a variety of factors led to the crisis. Developments in the subprime sector to begin with, excessive leverage in the financial system as a whole in recent years, lax financial regulation and supervision, and global macro imbalances. That is something I think almost everyone agrees that these were problems that led to the crisis. What I am particularly interested in, which I've written about separately, is the role of lax monetary policies in advanced economies as a whole, but particularly led by the United States. And I actually came across this when I had the opportunity of looking at capital flows to emerging market economies for the Committee of the Global Financial System of the BIS. That what we noticed was that capital flows to emerging market economies that have occurred in the last 30 years almost have been in waves, and almost each wave, right from the early 1980s, has been preceded by loosening of monetary policy in the advanced economies, particularly the United States, followed by tightening, which then led to reversal of capital flows. So, for example, in the period after the dot-com crash, lax monetary policy, there was a sudden reversal of monetary policy in the United States to cope with the dot-com crash, just as been the sudden reversal of monetary policy after the most recent crisis, going down to very low interest rate levels and essentially leading to excess liquidity. And what is interesting in some sense is that in previous episodes of such excess liquidity over the last 30 years, it was emerging market economies that suffered from crises because of this waves of capital flows. This time it has rebounded on North Atlantic economies. And what does happen is that when there's an extended period of lax monetary policy and low interest rates, there's a natural search for yields leading to usually outward capital flows in search of higher yield, of course. What happened during this recent period of monetary expansion is that with monetary policies being accommodated for an extended period of time in the United States in particular and the Eurozone also, that in addition to capital flows going outwards in an extended search for yields, the volume of liquidity generated was such there was also a burst in financial innovation within these countries looking for higher yields. The search for higher yields then led to a lot of irregularities that were observed, and there the financial regulatory and supervision system did not cope with these irregularities that were observed, or they're not observed in some sense because you were not looking for them. And the consequence, of course, is that it is advanced countries in the North Atlantic region which have suffered from this financial crisis. The other issue of note is that partly, and of course this is partly because of the large expansion in the global supply system of goods from China and other emerging market economies, and in the last 10, 15 years, really not just the last 5 years before the crisis, that whereas the accommodative monetary policy and increased liquidity, there was this accommodative monetary policy and increased liquidity, but it did not lead to higher inflation as measured by the consumer price index, or even higher inflation expectations as conventionally measured. And therefore, there was no reason, given the orthodoxy of monetary policy practiced in this period, for any monetary policy action to be taken during this period. It did, of course, because of this, lead to very significant increases in asset prices of different varieties, particularly housing and real estate, and not just in US and Europe, but also other parts of the world as well. But being particularly focused on the CPI or core inflation, as the case may be, central banks felt no pressure to tighten until very late in the game because they were not observing inflation increases as conventionally measured, nor in inflation expectations. And as I said, because of the prevailing orthodoxy, they avoided reacting to asset price growth and even to supply-induced commodity price increases during that period. And to my mind, this really is a major issue for the future for monetary policy, for central banks in general, and academics to discuss. And I feel that this is not an issue that has been discussed adequately. There is an interesting paper by Blanchard and others from the IMF as a discussion paper that came out, I think, 3 months ago or something, which has caused a good comment, but I have not seen that much other work. And I presume that people are cogitating they will come out with more work as a consequence of that particular paper, since it has come from the IMF. So the question is, in the presence of low CPI inflation, which is also currently the case, there's also that given the orthodoxy has gone so far deep into financial markets that actually it's very difficult for central banks to act when there is such low observed inflation because public and market pressure says, what do you mean by acting? Where's the inflation? So the question is, in what circumstances should monetary policy take cognizance of variations in asset prices and in commodity prices, and how? And also a connected question, which I'll now come to, is what should also be the role of coordinated action through prudential regulation? I won't say anything more on monetary policy because I'm talking much more on financial regulation, but I did want that as a backdrop because I do feel that provides the macro conditions under which financial regulation and supervision has to take place. There is, of course, much greater discussion going on internationally and within jurisdictions on existing regulatory practices and the future of financial regulation and supervision. Much more discussion than on monetary policy. And there's been a plethora of reports, both international reports, national reports. I've counted at least a dozen such reports, and all very significant, important reports from all important people in this area in the world, so to speak. What is common among almost these dozen reports is acknowledgement of that regulation supervision advanced economies was too lax in recent times. There needs to be considerable rethinking on leading to much strengthened, perhaps intrusive regulation. The Financial Services Authority has now constantly talked in the UK, which was in some sense the high priest of what I call lax financial regulation. They called it light touch regulation. That the sort of high priest is now saying repeatedly that you need intrusive regulation. Now, the interesting thing in a lot of this discussion really is that apart from the laxity in the supervision of banks, there was in some sense a serious conceptual flaw in the approach to financial regulation. It was assumed that microprudential regulation and supervision of individual financial institutions would also ensure systemic stability of the financial system. So this approach really ignored the possibility of the fallacy of composition, and a good deal of discussion now on macroprudential regulation is focusing on this particular point. Basically because they increase the complexity of the interaction of financial markets with even sound financial institutions can have negative systemic effects through cumulative negative externalities. Now, actually I had about 2 paragraphs on this, so I found this felicitous sentence to capture 2 paragraphs to shorten the time. So I'll just repeat that. The increase in complexity of interaction of financial markets with even sound financial institutions could have negative systemic effects through cumulative negative externalities. How do you like that, Charles?
Sounds good. Sounds good.
So there is clear recognition now of the need for contra-cyclical macroprudential regulation and the need to reduce moral hazard posed particularly by systemically important financial institutions, SIFIs, which are called CFIs, systemically important financial institutions. Now, what is the one quote I will give is one of the best reports I have come across, and I commend this to everyone in this audience. I presume the audience is here because they're interested in this issue, is the Turner Review of April 2009, which is on the FSA UK website. And the Turner Review is accompanied by a longer discussion paper, and both of them have lots of data, which I love. And to quote the Turner Review, in some way it really encapsulates the issues that have arisen. Lord Adair Turner, who used to originally work with McKinsey and he was also the chair of the Confederation British Industry before coming to the FSA. So he's not a wild left-leaning academic, right? Like Charles, being left-leaning, right, Charles?
Left-leaning?
So what the Turner Review says, at the core of these assumptions, behind a lot of the problems that took place in financial regulation or the framework of financial regulation, at the core of these assumptions has been the theory of efficient international markets. And he says that 5 propositions with implications of the regulatory approach have followed. So the 5 propositions that he puts out, which was the basis of light touch financial regulation, 1, market prices are good indicators of rationally evaluated economic value. 2, the development of securitized credit, since based on the creation of new and more liquid markets, has improved both allocative efficiency and financial stability. These are all assumptions behind the kind of regulation supervision we did. 3, the risk characteristics of financial markets can be inferred from mathematical analysis, delivering robust quantitative measures of trading risk. That's exactly what institutions did, what markets were supposed to do, what observers were supposed to do. 4, that market discipline can be used as an effective tool in constraining harmful risk-taking rather than regulation and supervision. And 5, financial innovation can be assumed to be beneficial, since market competition would winnow out any innovations which did not deliver value added. I'm quoting the issues that he outlined, which says, look, this was the root of our thinking of financial regulation, supervision. And he went on to say, each of these assumptions is now subject to extensive challenge on both theoretical and empirical grounds, with potential implications for the appropriate design of regulation and for the role of regulatory authorities. I find that of great interest, not necessarily saying that, look, everything was wrong, but saying that, look, this is the root of what our thinking was the last 15 years, based on the theory of efficient and rational markets, which led to the framework both of monetary policy and financial regulation and supervision was practiced. And that is really what is being examined, I think, worldwide. So what were the specific developments in the financial system that arose from I think I forgot the slides in my excitement to speak to you. So I'm actually 2 slides behind. So this is just, you can gaze it for a bit. I should have done that much earlier. So what were the specific development of the financial system that arose from these broadly accepted intellectual assumptions that led to the ongoing global financial crisis? First, the buildup of excessive leverage. Now, one of the other recent publications that I commend to everyone is the book by Reinhardt and Rogoff called This Time is Different. And actually, what's the most useful is if you read this together with the old Kindleberger book on what's it called, panic mania, and so on. So if you read those 2 together, actually saying this, the first book is This Time is Different, by question mark, Reinhardt and Rogoff, Princeton University Press, 2009, and Kindleberger and Aliber, which was update of Kindleberger's book, which he done in the early 80s, was revised a number of times. Actually, they say the same thing, except that Reinhardt and Rogoff say it with numbers, Kindleberger said it without numbers. But basically, financial and banking crises have a long history, which is as old as the existence of the financial sector itself. All liquid markets can be susceptible to swings in sentiment, which can produce significant divergence from rational economic prices. What is common among all crises is really the buildup of excessive leverage in the system and the inevitable bursting of the financial bubble that does result from such leverage. This is what has been found again and again, and we keep forgetting it again and again. What is ironic about the current crisis, to my mind, is that this excess leverage occurred over a period when greater consensus had developed through the Basel process on the need for the level of adequate capital required in banking institutions across all major jurisdictions. Furthermore, also, as we mentioned earlier, sophisticated financial risk management capabilities were also believed to have been developed during this period within large financial institutions of this period of unusually rapid growth in the financial system. So this has had some perverse result that because of the perceived increase in sophistication in the measurement of risk, high quality risk capital in large banks actually could be almost as low as 2%. That's high quality risk capital as 2% of assets, i.e. a leverage of 1 to 50. And also that because it was felt that you had this higher sophistication in large financial institutions, therefore you actually could have lower capital ratios in large financial institutions, and therefore you moved in the opposite direction towards moral hazard, and so now we're saying the opposite, which is that large financial institutions actually should be subject to higher capital requirements than in the past. There's a total reversal in thinking going on. So with financial deregulation in key jurisdictions like the United States and the UK, along with most other countries, financial institutions grew in complexity in the 90s and 2000s. And financial conglomerates, of course, began to include all financial functions under one roof: banking, insurance, asset management, proprietary trading, investment banking, broking, and so on. And the consequence, of course, has been inadequate appreciation and assessment of the emerging risks, both within institutions and system-wide. So what are the factors that led to this emergence of excessive system-wide institutional? No, I can't do a pointer in this. I can't fiddle with this. I'll have to. No, this is right. No, I've done it the easier way. No, sorry. No, you have this funny thing that you go to the thing and it switches to the other slides. So I couldn't figure out how to do it here. So I just went to do it manually. Now, among the most notable developments in the last decade has been the unprecedented and explosive growth of securitized credit intermediation and associated derivatives. The assumption underlying this development was that this constitutes a mechanism that took risk off balance sheets of banks and other financial institutions, placing it in a diversified set of investors and thereby serving to reduce banking system risks. And actually, as late as April 2006, the IMF's Global Financial Stability Report noted that this dispersion would help mitigate and absorb shocks to the financial system, with the result that improved resilience may be seen in fewer bank failures and more consistent credit provision. The opposite actually happened. The basic point there is that what really emerged was a complex chain of multiple relationships between multiple institutions, and hence a higher risk of contagion within the financial sector. Also that with the greater financialization and greater involvement of markets, taking things off banks' balance sheets and so on, that you actually depended much more on liquidity in financial markets and capital markets, and we really didn't think about the liquidity risk that when you do that, and that's really what came to pass in late 2008. It was assumed that these liquid markets would always exist, and hence securitized assets were assumed to be inherently less risky than illiquid long-term credit assets. What happened was, in a sense, that what securitization does is really turn illiquid assets into liquid ones, which in theory then disperses risks from the bank's balance sheets and also reduces the requirements for banking capital. But what happened really is that when you do that, the incentive to monitor risk from the originator basically disappears in the underlying assets, and so you stop doing that, and then no one knows, in fact, what the risk is. And also that because these banks are supposed to be liquid, you started funding them through ultra short-term instruments, even overnight instruments, and there was huge expansion in the repo market. So you were funding long-term assets through even overnight liabilities, with the assumption of keeping on rolling them on because liquidity financial markets. And of course, the financial innovation arising from the search for yields we talked about earlier compounded this problem as second-order derivatives proliferated over this period. And you can see that in the chart, the kind of huge expansion that took place completely unrelated to anything happening in the real economy in terms of the underlying assets on which these derivatives were built. And because most of these derivatives were traded in OTC markets, the valuation became increasingly dependent on model valuation and credit ratings rather than observable and transparent market valuation, and they were inherently more opaque. So when problems arose, the markets and prices were not visible, valuation of these assets and the shadow banking system became unobservable, and so trust and confidence evaporated and markets froze. So that's the first point on the regulation side. Then, of course, there was the corresponding emergence of the shadow banking system. That is, so these problems got further compounded by the emergence of this largely unregulated shadow banking system that took off assets from the bank's balance sheets, thereby reducing the bank's capital requirements, and they themselves are not regulated. So so in some sense, it's ironic actually, in a way, that the greater attention that was in the previous decade and a half with the Basel process, greater attention to the capital adequacy in banks itself, in a way, led to a poorly capitalized financial system overall, because you put an incentive structure where for the banks, they had huge incentive to take things off their balance sheets in order to comply with the capital requirements. And so you then led to a whole shadow banking system where there were no such requirements. So it just shows, it also tells us that financial regulators have to be awake all the time. And you can't just put in something through rules or principles and go to sleep. So the complexity and magnitude of the intra-financial sector transaction exploded over this past decade, and I've shown you the kind of the change that took place. To even take an example from the oil market, that the trading in oil futures increased from an equivalent of about 300 million barrels in 2005 to about 1 trillion barrels in 2007. I'm sorry, 1 billion barrels in 2007, which is more than 10 times the volume of oil produced at that time. So it's just financialization of these markets, and you then get prices, which we saw what happened to oil prices in 2008, then have no relationship to anything that's happening in the real economy. And the consequence of it was that the financial sector was therefore increasingly serving itself rather than any perceived needs of the real economy, which is why the profits grew, bonuses grew, and all the rest of it. So the financial sector therefore exhibited high profits and growth while doing relatively little for the non-financial sector of the economy, which the financial sector is supposed to exist in principle for. And as I said, the compensation levels in the financial sector increased explosively. So in the process of taking risks of the balance sheet through securitization, these risks actually, this is the important point, that what we thought that what all the system would do would be to disperse risks across the economy from the financial system, and that's good for risk management. Actually, what happened was that they all came back to the financial system because they were essentially trading among themselves. The rest of the economy was not trading in these instruments. And so you can see actually, in terms of numbers, the increase in liabilities within the financial system. Whereas if you take the financial system to the rest of the economy, there's not that much of an increase in liability. There's a very good McKinsey report, by the way, on debt and deleveraging, which shows that, but that ignores the intra-financial sector increase in debt. And so rather than reducing systemic risk, which was what we thought would happen, the system of complex securitization associated derivatives only served to actually increase systemic risk. And it became increasingly difficult to trace where the risk ultimately lay. There's been a great degree, a lot of discussion on these huge compensation levels, a lot of intricate formula now being given so that people have longer term views and you get bonuses for 5 years, clawback and all the rest of it. The question I raised really is that I think that's missing the wood for the trees. The question to my mind really is, that obviously, if the financial sector makes the kind of profits it did, and my recollection is about the financial sector profits in the United States were about 40% of total corporate sector profits at its peak in 2006-7 or 2007. So the question in my mind really is what is wrong in the system that that increase in profits does not get whittled down by competition in the financial sector? Because that's what economics would tell you. There's something strange other which I don't understand. Is it because of natural entry barriers? Is it because of regulatory issues? So to my mind, the discussion on compensation should talk much more on the structure, the sort of market structure of the financial sector rather than the intricate details on how you actually do the compensation, whether regulators should limit the compensation or whether there should be a clawback and all the rest of it. Now, in all of this, what I've just described, the regulatory system was clearly behind the curve in taking account of all these developments. The regulatory focus was on banks and not on the emerging shadow banking system, which the market is supposed to discipline. Sort of like that when you lose a key or a coin or something, you look at night on the street, you look under where the street light is, and not between street lights, because you can't see anything anyway. So that's really what happened to the regulatory system. The procedures for calculating risk-based capital requirements underestimated the risks inherent in traded securities instruments, which added to the incentive for banks to securities assets early into traded instruments, which bore, of course, lower risk weights. And as we observed, the trading of these instruments was largely OTC markets, which exhibited little transparency. And so through this process, the banks actually became effectively undercapitalized. And of course, the leverage ratios in the unregulated shadow banking system in Western banks just reached unsustainable levels across the system. And there was a clear failure overall of financial supervision. So a good deal of the ongoing discussion in regulation and supervision is focused on this issue through the mandating of increased capital requirements over the whole financial sector, in what we call increasing the perimeter of financial regulation. Now, what also has happened, of course, is that with the existing low interest rates which continue, mispriced low-risk perceptions and inherent incentives to originate, lending, and distribute securitized instruments, household indebtedness has increased to unprecedented levels in the North Atlantic economies, particularly in the US and the UK. So actually, the household debt to GDP ratio increased from an average of around 60% between the mid-80s and 90s to over 100% in the following decade. And the demand for assets arose, and hence housing prices, and we've seen what happened after that. So then what are the challenges ahead? The agenda that is being developed for the strengthening of financial sector regulation is really quite ambitious. And of course, as you can imagine, contentious issues are arising both at domestic level in different countries, within jurisdictions, and of course international levels in the international global process. Whereas the principles that have been outlined for this regulatory cooperation, for the regulatory overhaul, the principles are being, I think, in fact, it's somewhat surprising that the consensus that has been developing over the principles, but there's huge challenges and lack of consensus how to actually do it. You can't say just do it. And the practicality. First, there's this issue what I already referred to, is the regulatory structure and macro-prudential regulation. There is a great deal of discussion taking place in most jurisdictions on the changes needed in regulatory structure so the probability of such a financial crisis arising again is minimized. The regulatory regimes have to be more effective over the cycle. And there is general agreement across jurisdictions that we need to place a regime of macro-prudential regulation and financial stability oversight. So the United States are proposing Financial Stability Oversight Council. I read just in the paper this morning that the UK is also thinking of something like that. They haven't yet figured out exactly what they will do. So the issue and discussion really is, who will do it? Will it be a council of regulators? Will it be the central bank? Will it be the Treasury? And the core concern really is who is going to be responsible for maintaining financial stability. Macroprudential regulation is increasingly seen to be among the key elements for maintaining financial stability, and this requires the imposition of prudential regulations in the light of some macroeconomic or overall financial trends that need to be acted on. This is very important. We have not done that in the past. We did not act on macroprudential, we did not do prudential regulations because something happening in the macroeconomy or in particular sectors. So the question, if that is the emerging consensus, if the central bank is only a monetary authority and a separate agency like the FSA of the UK is responsible for financial regulation supervision, how can such coordination be implemented? The US has, of course, had a very fragmented regulatory structure, whereas UK had put everything in the FSA. In the rest of Europe, of course, monetary policy was central ECB, but the regulatory system has remained fragmented between countries and within countries. So this is an ongoing debate which is going on. The Europeans are trying to figure out how they can do some kind of Europe-wide level for financial regulation and supervision, which everyone then accepts. And so there isn't a fully agreed system yet, because all systems failed. The centralized system, FSA, failed. The fragmented system of the United States failed. The fragments of Europe failed. So there isn't, in some sense, best practices. Oh, that's the best practice. Let's do it. It's really an ongoing discussion which will go on. The UK has clearly announced that it is abandoning the complete separation of financial regulation and supervision from the central bank, and the FSA is proposed to be folded back into the Bank of England, so that the governor of the Bank of England will be responsible now, assuming this goes through, for monetary policy, financial regulation, and financial stability. Consequent to this crisis, it is felt that the central bank can better exercise responsibility for financial stability if financial regulation also comes within its purview. The US Treasury had, it's interesting that because they had the opposite system, the US Treasury in its paper last year had first recommended that the banking regulation be unified in a single agency separate from the Federal Reserve. The bill that has finally now been passed has actually kept the fragmented regulatory system, except for abolishing the Office for Thrift Supervision. And so what they've done really is that all emerging CFIs, the systemically important financial institutions, will be under the regulation of the Federal Reserve. The Office of the Controller of Currency will supervise all national banks, and the FDIC will regulate and supervise all the state banks. It is yet to be seen, of course, how this whole system will operate. What is clear is that there is now much greater acceptance of the role of the central bank in maintaining financial stability and in regulating all CFIs, systemic important financial institutions, not just banks. Let me just give a personal view that having worked in both the central bank and also in the government for actually much longer before I went to the central bank, that I really do not believe that effective macroprudential regulation and oversight of financial stability can be done without the central bank being at the lead of this activity. Any kind of group can be set up depending on the country's overall regulatory setup, because different countries have different legacies and systems, but and including the Treasury and other financial regulators. But I do believe that as the lender of last resort, the central bank is also the only agency which has an overall view of the economy. It also, and this is just a characteristic, that it has exceptional, almost all central banks have exceptional stability in terms of staffing and continuity in thinking relative to most treasuries and other agencies. It also has its ear to the ground, because it has to, with respect to evolving developments in all financial markets, even if it is not regulating those markets. And therefore, I do believe that that it is a central bank who ought to be mandated to be the lead of this financial stability oversight. In terms of detailed arrangements, different countries have different systems. Our own experience in the Reserve Bank as both the monetary authority and the leading financial sector regulator was that we were able to supplement monetary policy very effectively with prudential actions on a consistent basis. The Reserve Bank, I have to stop saying we since I'm not there anymore. The Reserve Bank consistently monitors credit aggregates, including movement sectoral credit. It therefore could take macroprudential action as early as 2006, when it observed excess credit growth both on an aggregate basis and in particular sectors in real estate and housing. So it increased, for example, the cash reserve ratio to curb overall credit growth and imposed higher provisioning and risk weights in lending to affected sectors like housing and real estate. This is much like a year and a half before the crisis. So it was prior action. As part of its supervisory activities, it also monitors incremental credit deposit ratios of banks and then acts if these ratios are found to exceed certain acceptable norms. It is also able to do forward-looking counter-cyclical capital buffering, which it did through increase in loan loss provisioning when it was needed. Further, when it observed regulatory arbitrage being practiced by lightly regulated non-bank finance companies during 2005 to 7, a couple of years before the crisis, that it took measures to tighten regulation on the non-banks because we saw regulatory arbitrage, reducing the potential ability to do excess leverage and do the regulatory arbitrage. So I actually believe that we happened to do this. When we were doing this, Here I can say we because we were there, I was there. We were doing this with very clear observation. We were not sure if, the certain judgments have to be made. So some risks were taken in doing these actions, and they were heavily criticized at the time. It turns out we were right. We could have been wrong. But the point is we were willing to exercise judgment because we had the monetary policy and financial regulation and supervision under the same roof, and so we had, in that sense, better information. So, as I said, I do think that the central bank needs to have both monetary authority and responsibility of financial regulation in some form. Arrangement with different countries would be different because people have different legacies. What I think is becoming clear, although I'm not sure what will actually happen, is that the increasing trend towards separation of the central bank and financial regulation will probably be reversed. But this is work in progress across the world. And I was surprised, certainly, that there was a discussion paper by Blanchard and Co. from the IMF which said exactly the same thing. The increasing trend, if it accepts the notion that together monetary policy and regulation provide a large set of cyclical tools, this raises the issue of how coordination is achieved between the monetary and regulatory authorities, or whether the central bank should be in charge of both. The increasing trend towards separation of the two may well have to be reversed. Central banks are obvious candidates as macroprudential regulators. This is what Blanchard and Co. said a little earlier in the year. So in any case, there's a clear need for a comprehensive approach to regulatory risk in the financial sector, particularly as the perimeter of financial regulation is widened to increase either to unregulated or regulated entities. I have to go a little faster. I can see that I'm actually coming to only 2 more minutes, but I'll have to take 10. But I'll try and be faster. There's clear agreement in the need for higher capital adequacy. In terms of higher capital, tier 1 capital for common shares and reserves, higher quality liquidity standards, maintenance of capital, counter-cyclical capital buffers, counter-cyclical provisioning, higher risk weights for trading and derivative activity, higher capital liquidity requirements, systemically important financial institutions, and prescription maximum leverage ratio. I won't go into all of the detail, but the basic point is that this is certainly accepted, that you really have to increase risk capital in all financial institutions, and even more, and just said the opposite, or in systemically important financial institutions. Now, what is interesting is that soon after the crisis, when this discussion started, which was early, about more than a year ago, there was little protest from the financial sector. Now, just as some normality is coming back to the markets, the financial sector, as might be expected, is heavily into lobbying in terms of not getting these things done, quite naturally. And in fact, just last week, there was a report of the FDIC chief, Sheila Bair, actually complaining in some sense that the lobbying efforts of the financial industry were actually bearing fruit among the standard setters in Basel. So this is an issue that, with all these capital requirement increases, what will happen? Now, but there's a real issue that if you have such increases in regulatory capital, all things put together, what will be the impact on lower? It has to mean lower profitability for shareholders, for equity investors. What will be the impact on the financial sector as a whole? Does it mean that there will be a slower pace of credit intermediation? Does it mean there will be lower economic growth? And so on. The key influential private sector banking lobbying group, that is the Institute of National Finance, has already come out with a calculation that if you do all the things that are being proposed, that it will amount to a combined loss in the US, Eurozone, and Japan to around 3% of GDP over 5 years of its implementation. Now, one doesn't know, but I do believe that you need to make these calculations, you have to do them carefully, and the question really is what I was saying earlier, that will this just reduce the intra-financial sector activity, or will it reduce the financing of the real economy if you do these things? I think that's the question, outstanding question, that has to be considered. Then the counter-cyclical capital requirements, there's general agreement that you to have counter-cyclical capital requirements. The question is, how will you do it? How will you know that the cycle is turning? At what point will you actually say when the boom is taking place At what point when the boom is taking place will you push in those extra capital requirements? And of course, vice versa. How will you know that you're turning down, and so you reduce those capital requirements? There, I think, a lot of practical question, and how will the market know? How will the regulators communicate? How will the regulators know when to do what to do? And for us, emerging market economy is even more complex because we don't have adequate data in terms of the business cycle identification, partly because we have much higher growth, so you can't see things turning as quickly. So I think that where there's the agreement that there ought to be counter-cyclical capital requirements in the financial system, the question is not resolved how you're actually going to do it. Then there's macro-prudential regulation for containing systemic risk. Once again, it's the old issue of how do you identify systemic risks like the build-up of asset bubbles? Do you take monetary policy action? Do you take prudential action? How do you do it, and when do you do it? So there's a lot of technical work that needs to be done on the identification of systemic risk and on the regulatory measures necessary, and what will be the enforcement methodology. And here's the international issue also, that to the extent that larger systems pose costs on everyone else, how will the larger systems be monitored in some sense? How will we all agree that, look, they must do this, otherwise we get affected? There is general agreement, fifth, on the extension regulation on all CFIs, markets and instruments. Again, there's an issue of implementation. How do we decide which financial institution is systemically important? It's clear that anything systemically important, you must act. The question, how do you identify them, particularly at the margin? Certainly, I think one can say that all financial institutions that have access to central bank liquidity window must be subject to capital regulation. And this is in the context of the United States that, in fact, the investment banks, that is Bear Stearns and Co., were not ex ante eligible for central bank liquidity. They eventually did get eligible. There was a way found to do it. So now there's understanding and clarity that, look, all such institutions have to be eligible for central bank liquidity. There's argument how you actually do it. But if they are, then of course they must be subject to this extension of the perimeter of regulation. Again, the question is that you do all this, but will there be excessive regulations that might snuff out entrepreneurship if not done carefully? Then securitization and derivatives. I think I've said enough on that, so I'll just say that there is a great debate that has emerged around the issue of securitized credit. There's no question that you need securitization in the world. It's been there for a long time. There's nothing new about it. The question only is, how do you know when there's excessive securitization, and also how do you actually regulate it, in the sense that it's to do with risk weights and all the rest of it on the securitized instruments, so that you put in the right incentive structure in the financial system. And how do you make the trading platforms for the derivatives much more transparent? But there is the broader issue, which I referred to in quoting Lord Turner. The broader issue of the utility of financial innovations remains to be addressed. Are many of these innovations largely unproductive and dysfunctional, and do they need to be discouraged or otherwise? That the explosion of the magnitude of such derivative instruments for a little benefit financial system is clear. You have that explosion. You can clearly say that, look, that explosion had nothing to do with any improvement taking place in risk management. But as I said, securitization is a time-honored methodology. It has done much to lubricate the financial system, housing mortgages and so on. So I'm not saying at all, I'm not arguing at all that you should stop securitization. The question is, how will you regulate the bad from the good in some sense? CFIs I've talked about. There's increasing debate on this, on institutions being too big to fail. How do you put in internalized insurance systems so that when too big to fail institutions do fail, the bill doesn't come to the public at large, and that you have provided some methodology so that the losses remain within the financial system. I have one comment on that, which is that there has been agreement, of course, in the new US bill. The Volcker views have been accepted, so that there is going to be a curve on their proprietary trading and so on. But I have one basic point on this, which is that actually it's very seldom that too big to fail institutions fail when there isn't a systemic crisis. And one example is something that started here. There was Bearings. Mr. Leeson, based in Singapore, caused the whole of Barings to fail, but no one bothered at that time about bailing them out, even though they were a large financial institution, because there was no systemic crisis. The question is, suppose that had happened during a systemic crisis, would they have been bailed out? So I think this question not being addressed, that usually what happens is that large institutions, except for accidents like Barings, actually don't fail unless there's a generalized systemic problem. And when there's a systemic problem, there's a panic level is so high, and quite rightly, with the macro authorities, that you have to bail them out. So whatever systems that you devise for internal insurance, you can't, that this issue, I think, will remain. One final point, which is really mostly to do with emerging market economies, that is volatility in capital flows. Excess flows, sudden stops and reversals have significant effects on EME financial sectors, the work in the capital markets and asset prices, and the economies as a whole. Management of this volatility involves action in monetary policy, fiscal management, capital management, and also financial market regulation. I'm mentioning this because this is not so much of a problem for advanced economies. It is much more of a problem even for large emerging market economies. So this will remain a challenge, because I do believe there's not adequate international discussion on this issue. And the point of mentioning this really is that, again, it involves coordination of monetary policy and a broader monetary policy and inflation targeting, coordination, prudential action, coordination, macro action, also capital management, perhaps even capital controls. I'm coming to the end. In response to the crisis, currently there's this issue. The monetary policy has been loosened substantially in major advanced economies. You have an extended zero interest rate equivalent, and there is an issue that if right now the monetary multipliers have basically disappeared, so that there's been huge expansion in terms of central bank sort of base money, but has not got translated into broad money, but it can happen any time. It has to happen sometime. And the question is, will the withdrawal take place in time, or will again go through the same cycle, what we went through after the dot-com crash, and a continuation of this cycle. And for EMEs, this sort of ebbs and flows of capital flows. So to conclude, what are the lessons? One, the first lesson is the practice of monetary policy and financial regulation had tended to become too formula-bound and too predictable. The prevailing monetary policy frameworks, essentially based on inflation targeting, have been found wanting. So the question is, what should be the basis of new frameworks that also look at other issues related to the maintenance of financial stability? And furthermore, will the new frameworks necessitate less separation between monetary policy and financial regulation? The second lesson is that the intellectual basis of light touch regulation clearly does not hold. The financial world is highly susceptible to systemic risk, herd behavior, and moral hazard, which consistently requires regulatory intervention. Third lesson is that within the new principles that are being debated, we should admit that in the face of unexpected developments that always arise in the financial sector, rules are not enough. There is an important role for the exercise of judgment by monetary authorities and financial regulators. In my view, that's what monetary authorities, financial regulators are paid for, to exercise judgment and not be blind sort of rule followers. Fourth, you have only 4, I have 5 actually. The fourth lesson is that the financial supervisors must supervise. Regulation by itself won't work. It must be enforced through active and intrusive supervision. Regulators must regulate and supervisors must supervise. The final lesson is that the traditional virtues of prudent fiscal policy, stable as opposed to unstable monetary policy, along with the maintenance of sustainable external accounts, should not be lost sight of in the presence of highly flexible financial markets. Thank you. I've gone 10 minutes over.
Thank you very much. Thank you very much for a very comprehensive and interesting talk. And I thought the last lesson about the virtues of prudence is a very important message to underscore. We'll find out if there is life after debt at some point in the future. Let me begin, before throwing open to questions, to just raise two issues. There is the saying that the devil is in the details.
Absolutely.
And you've described the work program on financial reform, and I think it's hard to disagree with the importance of more real capital, paying attention to liquidity and systemic risk. But like the doctor, the issue is the dosage. And from a practical point of view, one issue is how far are we going to go? Are we just going to have minor incremental changes? So I was wondering about your views on what is achievable as distinct from what may be achieved. And the second issue, you seem to be, by virtue of your focus on the macro-prudential, by virtue of your focus on the role of monetary policy, to be leading to a world where central banks will become even more powerful. And I'm wondering if that is the case, if that happens, what that means for things like central bank independence and accountability. Because it seems to me you could argue that we're going to be giving central banks enormously expanded responsibilities with clear implications for taxpayers, for social issues and the like. So just to begin with those two questions, and then we'll throw open to the floor.
Okay, let me give you some brief answers because one can discuss this till the cows come home. Right? As far as the dosage is concerned, first, the financial sector is lobbying like mad. All right, and so as far as I understand, I think these are still discussions going on. But as far as I understand, the expectation is that these new standards won't be applicable till probably late 2012.
At the earliest.
Yeah, at the earliest. Now, so even that, assuming that actually the world doesn't have any more accidents in the next couple of years, next 2.5 years, it actually become more and more normal. So my guess would be that if that happens, the chances of that dosage coming to 2012 will disappear, because then people feel no need. So that is why I think that it is important, as I said, to do these, to do much, that you need much more technical work to really try and understand the consequences, of each of these different requirements, whether that's capital buffering, or increase in capital, increase in basic leverage, increase in high quality capital, etc. That you really need to, I think, to do much more technical work, individual institutions level as well as the systemic level in different countries, and what effect it really has. Looking particularly at the issue of the servicing of the real economy by the financial sector, because otherwise you can get totally lost in terms of what will happen within the financial sector. And I think that's a problem. And I quite frankly have not yet seen this work. I'm told that that's exactly what the BCBS and the FSB, the Financial Stability Board, are doing, but I don't know what real work is going on. I guess we might know by the G20 September meeting, because they're supposed to report by then, or October meeting, I guess, in Seoul, to them. So the answer in a sense is that it seems to me to be clear that there has to be an increase in capital requirements. There has to be an increase in the quality of that capital through common shares and so on. You do need to look at the cumulative impact of all the different requirements to make sure that you actually do this so that the financial sector serves non-financial sector better and reduces risk. On the second issue of central banks becoming more powerful, more difficult question, we have clearly seen that the opposite actually placed much higher consequences on the taxpayer. So I think it's a straw man to say that by placing more responsibility on the central banks, that there's a greater problem for the taxpayer, because central banks will do things which in some sense are quasi-fiscal. But actually the absence of doing them, because they didn't have responsibilities, were much worse on the fisc. One thing what I'm going to be teaching at Yale is evolution of central banking. So I will have a better answer for you 6 months from now when I've done the course. But what is interesting to me in terms of preparing for this is that you continue to have cycles on what central banks do, depending on the needs of the real economy and economic developments at any given time in the world. So my view on this, and I said earlier that I'm from my own experience, that if you place a greater responsibility for financial stability oversight, which includes therefore coordination of monetary policy with regulation and supervision, that you're likely to reduce risk. What it does mean is that you need to give more attention to the technical capacity of staffing in the central banks and of course the leadership. My final point on that is that I do feel that some of the current trend, like placing the Treasury Secretary at the top of Financial Stability Oversight Council, and equivalents in other countries, I think is dangerous, because you then shoot up the problem to the political authority. I'm a believer in political authority, as I think anyone in democracy should be. And I do believe that eventually that's where the responsibility lies. So that what did happen in the crisis was that responsibility did shoot up, and that's going to happen anyway. But if you form a council where the Treasury Secretary or the political authority is in action all the time, rather than just during a crisis, you could make a crisis more likely, because there's in some sense less independence, also passing on the buck. That is, the central bank governor or the regulatory authority chief. Now, so, well, he's in charge. When we have 2 meetings a year or 3 meetings a year, he'll tell us what to do. It's his problem, not mine. So that also I see as a problem.
Thanks. Questions?
Sir, this is SYNOPSIS from Reserve Bank.
Oh, no.
So the problem what we foresee, I personally foresee, is the loose monetary policy. Financial crisis has more or less because of loose monetary policy following the bill. And the loose monetary policy in one way related to the dollar and euro with the reserve currency. Is it a time to shift from the dollar and the euro to some other currency, maybe SDR or maybe some sort of international currencies, rather than having dollar as a currency?
Actually, I have a suggestion for you. McKinsey did a series, got a number of academics around the world to do brief pieces on the future of the dollar. It must be somewhere on their website, and it is a public thing.
Plus, there's been several studies, Joe Stiglitz and co, on the international reserve currency issue. There's quite a bit of debate and discussion.
Yeah, but those pieces are brief and clearer than the Stiglitz report.
I agree with that.
Yeah, okay. So as I look at that, I also have a piece there on the future of the dollar. But basically, see, the point is that the global reserve currency has never been mandated to be as such. No one has said the dollar is the global reserve currency. They have emerged as such. So you used to have sterling as the reserve currency until the Second World War, effectively. And of course, much prior, because with the gold standard, it's a different issue. The dollar has emerged as reserve currency because of the global confidence in the dollar. There was an increasing confidence in the euro, so there was some shifting to the euro, but that has come under question in recent months. The renminbi is not yet a fully convertible currency, and in some sense there's high confidence in China, but there isn't yet high long-term confidence in the stability of China. I'm not making any comment either this way or that way, but in some sense giving a perception of what the global perception is. So as of now, the dollar continues to be the major reserve currency. I do believe that that over time something else will happen, but don't hold your breath.
Okay, question over here 2 questions.
So I started my career, I'm a video MPA 2011. I started my career in the 80s at Citibank under Walter Wriston, where countries couldn't fail. Now we're in a situation where banks are too big to fail. What do you see is sort of, I mean, we see prevention of financial crisis is very difficult. Just give us a view of potentially where the next financial crisis could happen and where we could, and the second part of that is, how do you see us regulating non-bank financial institutions such as companies like PayPal? In fact, I keep more money at PayPal than I do in my bank account because it's easier to transfer money. So it would be good to just hear your comment on that.
Well, the first question, you're elevating me to a level higher than most humans, so that is difficult. That one can't say, right? I think that let me put it this way: that the action taken in 2008-9 does suggest that we learned something from the Great Depression. And therefore, we were able to rescue the global economy from a possible complete disaster. Right? Now, again, one doesn't know. Maybe that's an overstatement of what the dangers that took place at that time. But as of now, it does seem to be the case. So, in the same analogy, I presume that we will have learnt from this crisis, and there will be some improvement in what takes place in the future. But history tells us that financial crises will always be with us.
You quoted Reinhard.
Right, exactly. So I'm not saying that we will never have another financial crisis. What I am saying is that I would presume that that just as there was learning from the Depression, there will be learning from this episode towards some improvement. And what the final question was?
Comment on non-bank.
Non-bank, yeah. No, I think that's an important question that I can only give one illustration again from the view that the Reserve Bank had. I don't know what is their view now. That we clearly had the view that all mobile banking, etc., must be connected to a bank. We were promoting mobile banking. We were not trying to curb mobile banking or electronic banking, etc., but it must be connected to a bank so that it could be regulated. So, to my mind, I think that whereas it's clear that you have new technology, so you'll have new instruments, you'll have new ways of the payment systems being conducted and hence regulated, we do therefore need to find ways and means of regulating such non-bank activities, either by connecting them to institutions that are regulated or regulating them directly, either way.
We have a question here.
Yeah, my name is David White. I've spent my whole career in credit risk management, mostly with 2 large U.S. institutions, one which came through the crisis very well and one which blew itself completely out of the water. Several years after I left the company, I would add. My question is really not so much on the macro area, which you're focusing on, but I don't hear anything about the board of directors' role in this. Your 4th point here was supervision and judgment. These guys on boards of directors are paid very well, and by and large, I think they've abdicated fully their responsibilities. And if it can't, I don't think it can all be at sort of the macro level. It's got to be somebody that's running the damn companies, and I don't think these people have done anything to make themselves worthy of the kind of money they get. And is anybody doing anything to try and, I mean, it's very hard to legislate, I think, but is anybody looking at that issue?
There is a lot of discussion going on this. But it is a very big question. It's really an old question of who is the principal agent in widely held companies. And so you have, in widely held companies, in the modern capitalist system, you have the shareholders who are dispersed. The board of directors is supposed to be the shareholders' representatives, looking after the shareholders' interest in the board, so that the management and the employees don't take off with everything. And obviously this question has been debated in the non-financial sector since the Cadbury report and all the rest of it, and also after the Enron and so on in the United States. The question, I don't know enough about this, but the question in my mind really is that that in a way, when we're making the kind of profits that the financial sector companies were making, so shareholders were happy because they were getting a reasonable distribution of dividends and increase in stock price. The board of directors were happy because they were getting lots of moolah on their for attending every board meeting. The management was excessively happy because they were getting amazing bonuses, as were the employees. So in some sense, there was no one to blow the whistle. And therefore, I come back to what I was saying is, therefore, what you really, that you can't, that as you said, it's very difficult to legislate what the boards of directors do. The question is, what do you do systemically? That this kind of coordinated, not coordinated, that's sort of automatic lack of incentives to do anything happens. So the answer to the question remains open, but there is a lot of work, of course, going on the issue of how you regulate the compensation system for management and employees. I have not seen much, I don't know if you have, Charles, I have not seen much on what you do for the compensation of boards of directors and the responsibility of the boards of directors. And I presume that what could be thought about, which I don't think is being discussed at all, is certain sanctions on members of boards of management. There have been this issue of financial liability of independent directors. Again, it's a very difficult issue because what happens is no one then wants to be a director of a company because you're not in day-to-day contact with the company. So look, if I'm going to be a director and I'm going to have financial liability, then thank you very much.
Two questions here and then over here.
I'm Ananta Nageshwaran from Julius Baer. The Turner report which you cited, April 2009, capital markets are efficient. Prices determined in efficient capital markets must be allocationally efficient. This is a transportation of the idea from theory of perfect competition, which works in the real economy, but hasn't worked in the financial sector. So it looks like more players in the financial sector ends up distributing returns across a wider number of participants, but doesn't reduce risk because the financial sector captures systemic risk, which is not diversifiable. Therefore, is the answer to reduce the number of players in the financial. What is the optimal size of the financial sector?
No, the opposite actually. See, it was assumed that you'll have many more participants. Right? But what has actually happened over the last 20 years is that the share of the largest, say, 20 banks, stroke investment banks in the world financial system has increased. It's much worse in the accounting companies. You only have 3 left. And they're supposed to do everything in the world. So the answer is not clear in that are there natural barriers to entry? In some sense, you would have better risk diversification if you had 20 Goldman Sachs, 20 Morgan Stanleys, 20 HSBCs, etc., rather than 20, including all of these. And the question is, why is that not happening? And actually, sitting in Asia, I think this is a very interesting, important question. That will it happen? At one point until the mid 90s, I guess, or the late 80s, Japanese banks were coming up internationally. Then they went down. Now the question is, with the continuing expansion of Asia, Chinese banks, maybe Japanese banks, other Asian banks and financial institutions, will we have a greater diversification of significant or systemically important financial institutions so that there is actually risk is more diversified? Because a good deal of participation in the financial market is really from financial institutions. There was an increase in both, particularly in the UK under Mrs. Thatcher, of retail participation in the non-financial sector shareholding. Otherwise, there's not been that much increase of the retail participation. So I think your question is an important one. And the answer really to my mind is of a greater number of significant financial institutions and reduction in size of the largest ones.
Thanks. We have one question here. Two questions at the back, which we can slip in if each is quick.
From? Ah, okay.
The question is with regard to one of your points that you mentioned regarding the control of capital, excess volatility of capital. I was thinking of some type of international tax, which is like Tobin type of tax. I think that should be considered, which can actually help limit or control the excess mobility of the capital. What's your opinion about it?
I don't think the Tobin. First, I think there are practical problems in Tobin tax. But second, I think that I don't think it's very effective. So actually, all you do is that you have a multiple exchange rate through putting in a Tobin tax. So effectively, you have one exchange rate for all transactions other than those transactions on which you put the Tobin tax. So all you're doing is a multiple exchange rate. And it can have it can have a certainly one-off effect in the sense that at the time of putting the Tobin tax, it will affect capital flows. But after that, it makes no difference. So I don't think the Tobin tax is very effective and has a lot of practical implications of what do you put the Tobin tax on, which transactions, at what frequency, and so on. So I think that's a problem.
Thank you.
Thanks. And that answer comes from someone from Yale. Next question.
Who was actually taught by Jim Tobin.
My question, I'm Amar Patnaik. I'm from the Master in Public Management course here in the NUSLKY school. My question is, the derivative market will always remain in the financial sector. The futures would also remain. Do you think as a part of the regulation it would be possible to put a cap on the amount of growth in this particular sector in a sectoral manner or in a composite manner, or you want that it should be 100% backed up by assets?
No, it can't be obviously 100%. If it's 100% backed up by assets, it will completely die. So that is obviously out of question. But no one knows what it ought to be, right? So all you can do is to put in certain right incentive structures, which does mean obviously greater risk weights, etc., so that you curb the expansion, and that, as is being done, and that you reduce the pure over-the-counter market. What I mean pure in the sense that everything doesn't have to go through an exchange, but you can have much more transparent reporting on electronic platforms for every transaction, which can then be observed, and that you reflect the cost of systemic risk from these things in the kind of capital requirements that you put on institutions trading in these things. But I think this remains an open question because, as I said, as has been seen, the explosion in the magnitude had nothing to do at all with anything to do with the real economy. It clearly did not reduce risk; it increased it. So, whereas I don't know enough to say they were useless, because I don't know if that's correct, and I certainly don't know about it. But I can say that it's clear that they were not as socially useful as they were supposed to be in terms of management of risk.
One of the important messages is we have various lines of defense within economies to try and avoid financial crises. The first line of defense must be the financial firms. It must be boards of directors. And perhaps having more real capital will create incentives for some of these things to happen. We have second line of defense, analysts, rating agencies, and we have the third line of defense, micro or macro prudential supervision and regulation. And perhaps what we need to be thinking about is how to strengthen each of these lines of defense and have them become supportive. I think one of the key lessons I draw from the recent crisis is that our lines of defense are too interdependent. If one breaks down, the others break down. So we need to strengthen and increase the independence. And ultimately, it's going to have to do with incentives. Incentives for people to manage risk better, and also Pigouvian solutions of externalities and taxing systemic risk. But it's going to be a solution across multiple fronts. And will we reduce the frequency of crises? Maybe we can reduce the frequency, maybe we can reduce the cost. We're not going to avoid financial crises, but the amount of collateral damage, the drains on taxpayers are such that I think there's an enormous social obligation to try and reduce the frequency and the cost. But look, thank you very much, and you've all given us many things to think about as we try and struggle our way out of this recent crisis. Thank you very much.